Morning, everyone. Welcome to SRAX Business Update 2022. This presentation contains certain forward-looking statements that are based upon current expectations and involve certain risks and uncertainties within the meaning of the U.S. Private Securities Litigation Reform Act of 1995. Words or expressions such as anticipate, plan, will, intend, believe, or expect, all variations of such words and similar expressions are intended to identify such forward-looking statements. These forward-looking statements are not guarantees of future performance and are subject to risks, uncertainties, and other factors, some of which are beyond our control and difficult to predict and could cause actual results to differ materially from those expressed or forecasted in the forward-looking statements, including, without limitation, statements made with respect to expectations of our ability to increase our revenues, satisfy our obligations as they become due, report profitable operations and other risks and uncertainties as set forth in our annual report on Form 10-K for the year ended December 31st, 2021, and our subsequent quarterly reports on Form 10-Q and 8-Ks as filed with the Securities and Exchange Commission. All forward-looking statements involve significant risks and uncertainties that could cause actual results to differ materially from those in the forward-looking statements, many of which are generally outside the control of SRAX and are difficult to predict. SRAX undertakes no obligation to publicly update any forward-looking statements, whether as a result of new information, future events, or otherwise. Now I'd like to pass it on to our CEO and founder of SRAX, Christopher Miglino.
Thank you and good morning, everybody. Thanks for taking the time to join us today for the SRAX 22 Business Update call. Before we get started with the presentation, we want to acknowledge the uncertainty that was created around our inability to file our financials in a timely manner. The first 9 months of this year have been extremely difficult from an accounting perspective, and we're glad to be moving on to our new auditors. We believe that our new auditors have the expertise and resources needed to provide expert analysis in a timely manner. With that said, for people who are not familiar with our products, I'd like to start by taking this time to introduce you to our company. Our core product is our SaaS platform, Sequire. Sequire allows issuers to manage their shareholders, engage and communicate with those shareholders, and a number of services that are key to managing the public company ecosystem, such as warrant management, the ability to email and SMS all shareholders, analytics on key metrics around shareholder activity, the ability to be up to date on the value of the company's shelf, the ability to run and manage all shareholder meetings, the ability to launch and manage their IR website, engage in predictive analytics around potential financing activities, institutional shareholder benchmarking and tracking, and competitive intelligence. Those are just to name a few. We then work with our customers to utilize our virtual conferencing platform to create market-specific industry virtual conferences. This year, we threw over 20 virtual conferences ranging from blockchain to semiconductors. We combine this with our LD Micro platform, which puts on several in-person events per year. The next LD Micro conference starts today and will host over 200 public companies and hundreds of investors in the Los Angeles area. All of these products are essential to our creating a community of investors and issuers and provide them with tools that are valuable to both of them. We've accumulated millions of profiles of investors, and we have the ability to engage them based on their investing profiles. It's all about the community, and we continue to build the tools to help our issuers and our investors build community. As you can see, we've had quite the growth over the last few years. Our revenues grew significantly from 2019, where we only did $87,000 in revenue, to this last year where we did $26.7 million. To say we experienced growing pains in this journey would be an understatement. We grew the infrastructure and the team needed to accommodate this growth. So, with all that infrastructure that we built, why did we experience this delay in our filings? So, after discussing with the company's former auditors and legal counsel and advisors, we sought pre-clearance from the SEC regarding 3 elements related to the company's reporting of BigToken, a previous company that we're involved with, and its related transactions. Our initial submission was in March, and our final conclusion with the SEC staff came back after May. The issues that were outstanding: we had the deconsolidation of BigToken. We requested confirmation from the SEC that as a result of our decreased ownership position and loss of control of BigToken, it was appropriate to deconsolidate and further account of our remaining investment as if we did not have significant influence over BigToken. Our communication with the SEC confirmed our position. Thus, we did not need to wait for BigToken to file their financials, which was initially a position that was being maintained by our auditors. The next was discontinued operations reporting of our BigToken entity. We requested confirmation from the SEC that as a result of the deconsolidation of BigToken and shift of our business focus to Sequire, we would report BigToken as a discontinued operation going forward. Our communication with the SEC confirmed our position. If this was not the case, we would have had to wait for BigToken to file. The valuation of the company's remaining investment in BigToken was also a significant issue. The carrying value of BigToken on the SRAX books was only $4.2 million. So meaning that we had it on our books completely at $4.2 million. So compare this to the value of the price times quantity, which would have put our position at $179 million as of December 31st, 2021. Meaning if you took share price and multiplied that times the number of shares that we had, it would have been $179 million. That would have resulted in a gain net of tax of approximately $103 million for SRAX. We didn't believe that this to be an accurate representation of BigToken or the remaining investment. We felt a more robust valuation process was warranted. We requested the confirmation from the SEC that a more robust analysis would be appropriate and acceptable. This resulted in us reserving almost the entire $4.2 million that was previously on the books. This paved a way for us to avoid massive swings in the future. If we would have booked it at $179 million on the upside, ultimately that amount would have come down on the downside. Let's take a look at revenue for Sequire. And now this is less, around $3.5 million in BigToken revenue for 2021. So the BigToken revenue is not in these numbers. Many feared that our auditors would find significant issues with our revenue due to our willingness to accept stock as payment for services. While this did cause significant delays, which we now hope to have remedied, it did not result in substantial changes in revenue. In fact, it was not until the last few weeks of the audit that our previous auditors uncovered 2 positions that resulted in additional modifications to our revenue. While we've made the changes to the revenue for those positions, we still hold those securities of those issues and could recognize a gain from them in the future as we monetize those positions. As you can see, year over year, we had significant gains of 312%, and operating income went from a $7 million loss to just about break even. The change in the revenue is driven by changes in the asset value of the marketable securities. While the value of the position declined since our last reporting, they've increased 93% since the prior year. A reduction in asset also means the reduction in deferred revenue. And this reduction in asset value is almost in line with the reduction in deferred revenue for the previous year. What this means is when we book the revenue or book the asset of the securities, and we haven't delivered that service for the remaining of the year, we need to book that as a deferred revenue. In this case, it's almost equaled itself out. We had a lot of non-cash items for this year, and I think it's important to talk about that. But just to get to the bottom line of that before we talk about the details of it, the EBITDA number is around 1.76 million for the year, over a $5.7 million loss the year before. This was driven by a lot of non-cash items. So if you look at the loss, it looks like we lost $34 million for the year. Well, the first thing that's there is a 10 million non-cash item associated with the repricing of certain warrants in 2021. Then there's a $7 million mark-to-market loss of marketable securities, which doesn't mean we sold those securities. It just means that the mark-to-market was down $7 million. But the big item there is $18.5 million associated with the big token transaction. So when you add all of those up and take them out, you get to the 1.8 million, or approximately 1.8 million in EBITDA for the year. So on the balance sheet, you can see our current assets are based on the valuations associated from our valuation experts is approximately $23 million. We previously reported that the valuation there was around $28 million. So around a $4.8 million difference in the valuation of those securities. Now that's offset by a $4.6 million difference in the deferred revenue. But if you look at this on a year-over-year basis, then you're seeing a change from 11.8 million to 22 or almost 23 million. So it's very significant change on the asset side. The market for small stocks has declined significantly since the beginning of the year, and most of these companies are in the process of raising additional capital, thus increasing our holdings more. So when you see our stock portfolio on the balance sheet, or the price times quantity located at SRAX.com/stock-portfolio, you need to keep in mind the value of these resets should be added to the balance. We've hired B. Riley Advisory, a very well-respected valuation company, as well as do a lot of other things, but they have a very good valuation company, and they are valuing our stock portfolio on a quarterly basis. One thing to keep in mind is that the value of our portfolio is driven by resets, and those resets are taken into account when companies do future financings. Now, one thing that is not represented in our numbers is the value of those resets. And it's a question we get a lot. What is the value of those resets? Well, as of last week, those resets represented approximately $10.4 million. That's a significant number. So the market for small stocks has come down significantly, but when they do new financings, we get additional shares and reset. So that value of $10.4 million is not calculated into the value of our portfolio. So when looking at what we present online as the value of our portfolio, please keep this in mind. There are additional $10.4 million worth of resets that are out there. And the beauty of resets is that they don't require any additional tacking period for the 144 hold period. So if we did a deal 6 months ago and that 144 hold period has elapsed, and then we get additional shares later, we then can start selling those additional shares immediately without having to wait any further. I'll now turn the call over to Mike Malone, because I want Mike to walk you guys through a little bit more about how the valuation process has worked and what we've put into place around the valuation process. Mike?
Thank you, Chris. As Chris mentioned, business has grown significantly. And as part of that, we've had to broaden our criteria for allowing our customers to pay in securities, as well as accept additional types of securities that we hadn't in the prior year, such as convertible debt, preferred stock warrants, and so forth. As we've expanded our business, we've taken on all types of clients, and some of which are issuers that are more speculative. They're more in the early stage of their public company life, and we require a more complex process around the valuation of those securities. As you can see from this slide, approximately 60% of our entire portfolio as of 12/31 was valued using level 2 and level 3 fair value requirements. Just as a little bit on that, we've provided a explanation as to the what makes up a level 1, level 2, and level 3 security. Well, the first thing to say about that is that the accounting guidance, I guess, requires that issuers classify things on their balance sheet, or rather in their footnotes, as either level 1, level 2, and level 3 to provide insight into the level of subjectivity associated with that balance. As all of our positions are in publicly quoted securities or securities that are convertible into those with a public quote, much of the additional analysis involved is around the determination as to whether or not the quoted price of that issuer is from an active market, as well as the estimated required holding period of the security, commonly referred to as the Rule 144 holding period. As it relates to us, our level 1 assets are generally the stocks that we receive from issuers that require only a 6-month holding period and are generally liquid. These positions are valued strictly on a price times quantity basis. Level 2 securities are those that either have a holding period greater than 6 months or they are less liquid. These securities are valued based on a price times quantity less a discount based on the marketability and liquidity. Our level 3 securities are generally comprised of our convertible debentures and the stock positions in speculative issuers where the public quote isn't reliable, i.e. it trades very infrequently, or the percentage of the shares in the float represent an extremely small percentage of the total shares outstanding. The resulting valuation is mostly based on inputs other than the public quote or perhaps a bid-ask spread. Using level 3 investments as an example, the valuation process includes several significant unobservable inputs. For common stock, this is generally based upon a put option pricing model that represents a discount for lack of marketability, and this can range anywhere from obviously 0% to 54%. And the one thing to point out with that, this is a combined percentage as it relates to both the the holding period from a 144 legal restriction, as well as a liquidity discount that we would take for something that would take a significantly longer period of time to get out of, based upon the the trading volume of the issuer. For our convertible debt, we use a combination of a DCF model and an option pricing model. One thing I think it's important to point out is that these fair value designations are revisited at each reporting period and often change period over period. An example of this is our level 2 securities that include marketability discounts due to Rule 144 holding periods. As time passes, the remaining holding period decreases and eventually falls off, thereby moving the valuation from a level 2 to a level 1. As a consequence of this, as the holding period decreases, so does the associated discount. So other things being equal, i.e. if the quoted market price stays the same as an example, and the discount decreases or eventually falls off, that difference in fair value is accreted through the P&L. Our annual report goes into all of this in much more detail. One thing that I think is important to point out to contextualize all of this is and a question that we get quite a bit is, how significant is payment in the form of securities? As you can see from this slide, in 2021, approximately 75% of our recognized revenue was paid for in the form of securities, up from approximately 60% in 2020. And with that, I'd like to turn the call back to Chris.
Thanks, Mike. Now that you have a little bit more of an understanding of the process that we just went through on the security side, let me talk to you about, how does it work when we're selling these stocks? We get a lot of questions about how we monetize the portfolio and about our liquidity. When we get a stock, it is typically required that we hold it for 6 to 12 months, and in some cases, 24 months. These determinations are dependent on the number of factors. Once a stock becomes available to sell, we start the liquidation process. We typically do not exceed around 10% of the daily volume of any stock that we're selling. We're selling a number of positions on a daily basis. We spent a good part of 2022 setting up the appropriate relationships to make this happen and to optimize the legal and operational process. Believe me when I tell you that it's not easy. It's not an easy task, but we believe we have it down now and are getting things unrestricted in a very timely manner. Now, in some cases, we may sell restricted shares at a discount. We have established relationships with investors that are willing to buy restricted shares from the company at predefined discounts. In some instances, we may look to these investors for additional liquidity when certain stocks increase in value, but yet are unrestricted and things of the sort. So how are we changing our contracts now that we've now seen this additional modifications to the value of the contracts and how that's translating into revenue? With our customers that pay in stock, there's significant price elasticity. So we've made modifications to how we're pricing these transactions. Here's a typical stock transaction that's out there. So you have the contract here would be for $500,000. So the price times quantity of the stock would be $500,000. After running through our valuation models based on liquidity, length of time that we need to hold it, this particular stock would have a revenue recognition of $350,000 during the 1-year period of the contract. So you can see here quarter by quarter the amount of revenue that we'd recognize for that contract over a year-long basis and what the value of the deferred revenue would look like over those 4 quarters. Now, what we're able to do is go back to these customers and say, look, if you want to still maintain a $500,000 contract, we need to increase the value of that to $725,000 because the discount associated with a $500,000 contract is going to result in $350,000, not $500,000. In this case, we would take in $725,000 of new stock, and that $725,000 would then equate to $500,000 in revenue allocated over a 1-year period. So we're finding that bringing this model to the market has been successful, and since a lot of these companies are small in nature, they're willing to participate in this manner so they can still get $500,000 worth of services from the company. You'll notice that in our 10K, we repurchased approximately $800,000 in stock in 2021. We're also required to buy another $1 million worth of stock under $5 a share, if the stock's under $5 a share, within 30 days after getting access to the second part of our credit facility. I only mention this because, some people have mentioned that they wonder why we bought back stock. And obviously we felt the stock was at a good price at the time, feel it's at a much better price today than it was then. But we will continue to repurchase that stock as we get access to the additional capital, and we'll be required to do so once we are current on our filings. So speaking of the credit facility, the revolving credit facility was for approximately $10.5 million. Now, I want to be sure that everyone understands how our payments on the facility work. We're required to make payments based on the amount of stock that we sell in any given month. There's no mandatory amortization payments, just payments that are a percentage of the sales of the stocks that we sell. That percentage increases over time and tops out at around 20% of sales that are applied to the principal and interest of the credit facility. That's the most important piece of the facility because it doesn't require us to make massive payments on a amortization, even when we may not have the liquidity there. So it's all based on what we're selling out in the marketplace, and that's minimizing our risk. So when we started to hear the rumblings of the slowing of the global economy, we took quick actions to reduce expenses on non-revenue producing costs. In September, we eliminated approximately $230,000 a month in cost, or $2.8 million a year in expenses. Due to severance payments and additional costs associated with the reduction, we start to see those benefits and savings starting in November. It's important to point out that the reductions that we did there were related to non-revenue producing products. So we were able to, keep the existing revenue and not impact the development of the existing products that are producing revenue. So now let's talk about a few features. I want to tell you guys about some of the new features that are out there. We've done a couple of press releases, but want to talk a little bit in more detail. First, let's start with the Deal Center. So the Deal Center allows issuers to track financing transactions that they enter into, and it allows them to understand what's happening with the shares that they're issuing out into the marketplace. So as a company, when I issue new shares out into the marketplace, there's a lot of things that I need to keep in mind. I need to understand, are there any warrants associated with that transaction? Are there any resets? Are there any ratchets? Is there most favored nation clauses in those agreements? And the Deal Center tracks all of those things for the CFO, so that if in the future somebody's doing a transaction that is causing a reset or a valuation to be changed that has to then be applied to the P&L, the system will notify them and allow them to know what that amount is. So once that financing is in place, you can then see what the impact of that financing will do to the stock over time. And you can do this, the company can do this prior to entering into the transaction. So they can do a simulate what the transaction will look like over time and what the impact of the sale of that stock will have on the company's stock over a certain number of quarters. This is very important for issuers to understand because many times the investors say they're long-term investors, and this system will allow them to know based on historical data what those investors have typically done in the past with their shares and how quickly they do it. Once you do that, the system then can optimize. So the system then will allow you to create a mock transaction, and then you'll be able to see that what the impact of removing certain people out of the transaction will have. So you have the ability then to say, look, I'm going to remove these two investors. And if I do that, that's going to increase the value of my stock over time, or that's going to increase the amount of time that's going to take for these particular investors to sell our stock. It's a very powerful tool for the issuer and for the C-suite when they're making financing decisions. So let's talk about the next thing that we just launched. We just launched the investor community the other day in beta. We're excited about it. We've been working on this for a really long time. So let me show you a short video about how the platform works.
The Sequire community platform connects issuers and investors through Q&A events. For public companies, this tool includes the ability to host a Q&A event with shareholders to learn what is top of mind for your investors and to answer their burning questions. For investors, the Sequire community platform allows for new investment discoveries and getting top questions answered by companies you follow, helping you to make sound financial decisions. Soon, participants will be able to get verified by connecting brokerage accounts, upvote questions, start threads, insert graphs and links to get the message across. The Sequire community platform is an engaging way to open the door of communication. Email wecare@sequire.com to learn more and get a demo.
So the first thing that happens here is you would select the company that you're looking for. So in this case, you would look to SRAX. Then you would see the different events that they have happening. So in this case, we have a business update that you guys are on today. Tomorrow, we have our LD Micro presentation. So these are both two events that you can click into. So once you register, you can start asking questions of the company. Now, the issuer has the ability to choose whether they want only verified investors or if they want to allow all investors to be able to ask questions. When I say verified, it means that the company themselves has the ability to say, I only want people that have proved that they are investors in my company to be able to post here. Some companies might leave it open at first, especially to bring their investors into the platform, but then later might get more strict about who can actually comment because they don't want people that don't actually own the share commenting on the company. So it's really up to the issuer about how they want to do that. They can leave it open or they can close it down. And then once questions start to get posted into the system, then other investors can upvote questions that they think are important. So the company can see, how the community feels about these questions that are being asked. We also have our microcaps.com site. Microcaps.com continues to grow. It's really getting a lot of traffic. It's got, it's the first thing that comes up when you Google microcaps. So it's just getting a lot of natural organic traffic. And then within the microcap site, we've now interviewed hundreds of CEOs, CFOs, IR representatives of companies telling their story to our audience within the microcap space. And within I know we talked about this a little bit earlier about our virtual events when we were telling you about our products, but this next year, I think we're probably going to launch around 28 different virtual events. We've really built up the virtual events platform significantly, and lots of banks are coming to use it. Lots of banks are asking us if they can use our platform and if they can throw their own virtual events on the platform. So we're getting a lot of people utilizing the Sequire platform to throw those events. Obviously, none of this could be possible without our amazing team members. We have lots of amazing team members are writing incredible code and coming up with amazing ideas around all of these things that we do. So that's our building down in Mexicali, Mexico. So we have quite a representation down there. We're a big part of the community down there. We've been down there now for around 10 years. So it's our 10-year anniversary down there. So we're very excited about that. We have around 132 employees across the board. And now we'd like to go to our platform and answer some questions that some people have asked there. The first question that we have has been voted to the top. It says that I saw that the auditor had a PCAOB fine in 2021. What was the nature of that, and did it affect SRAX audit tardiness? Well, this is a previous auditor. So they're, they're no longer our auditor now. That was our previous auditor. We didn't know anything about their fine or anything about their, apparently they were, had a significant fine and had a third party oversight that was put on them for around 3 years. I'm sure it had some impact on the work that they were doing for us. But no sense in looking back. We're just, looking forward and excited about the new auditors that are going to take over. We'll put an 8K out on that in the next few days. And so you guys can see who it is, but it's a very large auditor that I think everybody will be excited to know is on board and helping us out. The next question is, if you added the value of the portfolio held by SRAX and the value of the LD Micro Conference, what might be an effective market value in total? Well, if you take the price times quantity of the marketable securities of around $30 million, you add in the $10 million worth of the resets that we had. So you're looking at around $40 million worth of value. And if you take, the value of LD is a very unique business. It has, can you look at that business on just the EBITDA or just the revenue that it's generating? I don't think you can, because there's so much value that gets attributed to the business itself, that benefits banks, that benefits analysts, that benefits service providers that are trying to reach issuers. So it's a very powerful tool. So, I think that collectively those things worth well more than where the stock is trading today. Just the portfolio itself and adding in the resets would get you to around $40 million, and whatever value you would then attribute to LD Micro, obviously would put you well in excess of the market cap as it stands today. Also, could we have an update on the revenue run rate for calendar year 2022 for Sequire, and have the margin stayed strong? So our new auditors have asked us that before we start sharing any new numbers with you guys, that they get a chance to opine on it. So we're just going to hold off on that for a little bit. We'll get that to you as soon as possible. We want them to, out of respect for their process, we want them to get started and get on board, and make sure that everybody's in order. And so we're going to hold off on answering that one for now, but as soon as we can, we will. The next question is, in the view of SRAX management, does the current share price reflect a good entry point for a shareholder buyback program? Well, for shareholders, I think what you mean is the person means, is it a good entry point for the company to start buying back stock, not for the shareholder buyback program. Obviously, we can't comment on the stock price at all, but obviously investors should do their own research and make a decision about whether or not this is a good investment for them. The next question is, how soon might we see the Qs filed? We'll have a full plan for you in the next few weeks here, and we'll have a full calendar about when that's going to be done. But it's being worked on every single day, and a team of people is working on it. And that was the challenge that we had previously. It was a lack of resources and from the audit side, and now we believe that the team is there to make that happen, and they'll be moving this forward as quickly as they can. The next question is there an expected profit target from the LD Micro event this week? How is expected attendance versus before COVID? The event is sold out, so it's very well attended, and the profit margin itself, each event generates somewhere between $1 million and $1.5 million per event, and they typically cost somewhere around $500,000 to put on. So they generate a good amount of EBITDA and free cash flow from the events. And the beauty of the LD Micro event is that the payments for the event come before the event. So typically the revenue that's being received is received anywhere from 90 days up until the week before the event. Whereas our stock business revenue is being generated typically 180 days after we start with a contract. So LD Micro has a much better cash flow profile than our other businesses. So combined, they do well together. The next question is, what is the current value of the shares warrants currently in the portfolio of SRAX? I think I answered that question already. Currently on a price times quantity basis, it's around 30 something million dollars. And if you add in the additional $10 million worth of resets, you're looking at around $40 million of assets. Now, that's without any type of discount that Mike covered earlier, but that's just the price times quantity. The next question we have are your customers re-upping their contracts when they're expiring? What is the typical contract in terms of shares versus cash? So Mike mentioned that earlier. We're seeing around, in the past, I've seen a 75-25 value of people paying in stock versus cash. But we've made a concerted effort this year to really push on the cash side of the contracts, and we're seeing that increase significantly. So we're seeing, you'll see those numbers increase here into Q3 and Q4. And yes, customers are, we're still maintaining that growth. We're still maintaining that renewal rate. The next question is, given the craziness of the market, how are you planning to monetize payment in kind of the owned equities? Well, as I mentioned earlier, we've hired an internal team that is doing nothing but unrestricting those shares when they can become sold, getting them to the appropriate broker, appropriate custodian to put the shares at, and then we start to sell the shares. Obviously, we never want to hurt the stocks that we're involved in, so we sell them, very, very slowly, just a little bit a day. And so our goal is sell a little bit of a lot of different stocks on a daily basis, and that gives us the liquidity that we need. So that's all the questions that we have today. If anybody has any additional questions and you want to ask that, you can go to sequoiacommunity.com and you can ask questions for our event tomorrow for the LD Micro event, and we'll be glad to answer those. We'll be presenting there on Tuesday evening, 5:30 Pacific time. So you can get your questions to us before then, and we'll be happy to answer them at the event itself. Thank you, everybody. I really appreciate your time today. Hopefully this was knowledgeable and gave you some more information about what we're doing, how we're dealing with liquidity, how we're moving forward. And we owe you some additional information on the timeline of the queues and all of the other things that we said that we'd get back to you in this call. And those things will be forthcoming in the next short order here. So thanks for joining us today. We appreciate it, and look forward to continue to have you as investors, and we appreciate you sticking with us. Thank you very much.